Welcome back to the channel, guys. It's your boy Seth, and I'm talking to you today about a new Pulsechain gem. Now, how can we be talking about a gem of a gem? If you've been following the channel, if you're familiar with some of the tangential talk that we've had about the upcoming Pulsechain mainnet launch, then you're aware my big question has been, where will the value come from? The additional value that's going to lock up on Pulsechain, where will it come from? And how many protocols will choose to align themselves with Pulsechain when it launches? Well, here to help me answer that, Jesse the Pit Boss. And we had a great time, both on camera and off camera. I'm really kind of sad that a lot of our conversation was not captured. I mean, we could have kept it a lot more light and breezy and maybe even live streamed it. But at the same time, here's a more tactical overview of the Liquid Loans project that will be launching on Pulsechain once it goes mainnet. Guys, before I show you the interview, make that subscribe button explode and click the thumbs up as well. Be sure you're notified for when new media comes out. You don't want to miss gems during Gem Hunter season. You don't want to miss any of this content coming out of the Mine Your Biz channel. Thanks for hitting those buttons. Thanks for sharing this video with a friend who wants to know about gems like this. Without further ado, let's hear from Jesse the Pit Boss and learn more about Liquid Loans. Today, we've got a special treat. This is actually one of the first few dedicated Pulsechain projects that's going to launch specifically for the support of the upcoming Pulsechain mainnet. I have with me Jesse the Pit Boss, who is the lead and the founder. I don't know exactly how you guys are dealing with titles.
Founder.
Okay, there you go.
We do have a large team, but I am the head of growth and adoption.
Awesome. Awesome. So head of growth and adoption at Liquid Loans, which is as you've explained it to me and as I understand it, an algorithmic stablecoin that is meant to help generate a bit more value in the Pulsechain ecosystem and keep people from having to sell their Pulsechain tokens, but still be able to work with stablecoins. I'm fascinated by this, the idea of the idea of synthetics, but in particular what you guys are working on. So tell me a little bit, like, what makes Liquid Loans special? What's its lineage as well? We live in an open source world where everything comes from somewhere else, I guess.
Oh, yeah.
So tell us all about it. What makes it unique?
Yeah, cool. So there's a ton of different stablecoins in existence, right? And the vast majority of them have some sort of counterparty risk. There's either a central entity, a bank, or a large institution that takes fiat dollars. They essentially lock that up, and in some cases even leverage it and do other trades off of that fiat. And then they mint some sort of stable coin that's backed by that value. That's primarily how most of these stable coins operate, but there are some decentralized stable coins that will take your collateral, you lock it up, and then you mint a stable coin off of that value. Same way, right? What we've noticed is some of these other stablecoin protocols, though, they're almost broken, right? Because they'll either use their own native coin of the project itself as the only thing that you're allowed to lock up, right? Which is extremely volatile when you use that method. So they require like 600% collateralization. Then there's other protocols that will burn and mint continuously just to try and maintain some sort of stability in the stable coin. Others will use the fees almost to the same effect. They'll take the fees and they'll funnel it back in and try and supply value. They'll purchase their own token, sell their own token, back and forth, trying to maintain some sort of stability. And it's just absolute chaos, and it's ridiculous. So after looking at dozens and dozens of these protocols, we found the perfect one. And it comes from a highly successful protocol on Ethereum. We decided to fork it. That's called Liquid Loans. It's quite simple how it works. You take Pulsecoin on the Pulsechain, you lock it up. You lock up whatever collateralization level you would like. The protocol only cares that you have in your personal vault at least 110% of the value of what you've minted in the form of USDL stablecoin. Okay, you're then free to do whatever you want with that stablecoin. Now, if the value of your Pulse, if it appreciates, or if you chose to do the wise thing and over collateralize, it's likely that you would never ever lose your Pulse. It'll just continue to go up in value. It's yours. In fact, the protocol lets you withdraw that excess collateral or mint additional stablecoin off of that excess collateral. Okay, so that's one side. That's like the borrowing side. You're simply locking up one thing, you're minting something else. You've collateralized an asset, much like you would with a home. That would be called a HELOC, home equity line of credit. We call this a crypto equity line of credit. Okay, so that's one side of the protocol. If you wish to pay back a loan, which you don't have to, by the way, there's no repayment terms, as long as there's at least 110% of what you've minted remaining locked. So there's no repayment that ever would have to occur unless you choose to. There's also no interest. There is a fee that's attached to the beginning of every loan. That fee gets paid to people inside of the protocol, so the user base. If you did choose to pay a loan, all you have to do is bring back your stablecoin. It burns itself. Remember, it minted out of thin air by you locking up another thing. So you bring it back, it burns that stablecoin, and it releases that thing you locked up, right? Of just about equal value. Okay. Now, let's say somebody chose to under collateralize. Let's say they locked up 110% of what they minted. The market turns against them a little bit. Somebody in the community will push a button and liquidate Pulsecoin, which will then leave that person's personal vault. It will go to a pool of stability providers who have stablecoin waiting to burn for that person. So instead of the borrower paying back a loan, you have stability providers that have said, well, we're willing to pay back the loan if somebody chooses to have under collateralization. Their Pulse gets liquidated. We go ahead and pay. It burns their stablecoin. They obtain the Pulse. So they get the
and
Pulse.
This is and I apologize for the interruption. This is in a private pool then. This is not off platform. This is not outside of the smart contract or the ecosystem of liquid loans.
Correct. Inside the ecosystem, all within one DApp. This is all occurring within one DApp. Okay. So these stability providers would be obtaining Pulse in those scenarios. They would be burning stablecoin. But there's one other feature of this protocol. So the stability providers are farming this thing called the native token while they are participating as stability providers. They're being incentivized. They're being incentivized to have stablecoin on standby to pay for any liquidation events. And they're being incentivized by them farming this thing called a loan token. And it's not a duct tape on token like you see in a lot of protocols that really doesn't have any use case.
Yeah.
This has a really good use case. You take that token and you stake it and you collect the fees from the loans. Every loan comes with a small fee at the beginning of it that's taken out of the USDL that's minted, and it goes straight to the stakers of this loan token. There's also Pulsecoin that is a fee from arbitrage events between USDL and Pulse. Those fees also go to the stakers. So as a staker of the loan token, you're collecting Pulse. You're also obtaining USDL from all the fees.
Wow. So it's good to be a loan token staker then, is what you're saying. You're
absolutely
the best of all worlds.
Absolutely. So this whole mechanism, everything I've described from start to finish here, it really is a community bank. All the banking is occurring with the user base.
Okay, so you've got decentralized sort of hard money lenders. You've got decentralized HELOC participants, or crypto CLOC participants, right? Crypto, equity lines of credit, and then you've got a decentralized payout mechanism to ensure that the repayment terms of the lenders is fair, and that the liquidation of under collateralized loans is, whether it's fair or not, it's agreed upon, and people are playing by those rules. So
absolutely
cool. Okay. Yeah, I think I'm starting to get it. Like
you did say hard money lender. What's interesting though is nobody's lending you the money besides the smart contract that you created. You bring in Pulsecoin, you generate a smart contract, and it issues you stablecoin. The protocol as a decentralized entity existing on the Pulsechain is you're your own lender.
Okay, so the supply is elastic then, based on demand, based
Correct.
on participation of this smart contract that then mints on demand.
Correct.
Okay, cool.
There could be an unlimited supply of USDO. There is a fixed supply of the loan token.
Okay.
And it gets harder, and it does get harder and harder to obtain as the years go on, because the rate at which that is farmed is halved every year.
Oh my gosh. So you got FOMO mentals in addition to the pumpamentals. Got it. So you got to get in. You want to try to get in early if you got the whatever the collateral lying around that you could commit to obtaining loan token then.
Right. Correct.
Oh, cool. All right. Okay. Got it. I'm starting to understand a little better. Like, clearly I've done the tiniest bit of homework, and I'm trying to make sure that that I'm asking good questions rather than not just like whatever, like, but what about, my roads, like stupid, like completely non sequiturs.
Let me explain how this came around. I want to say like 6, 7, 8 months ago, a lot of us in the Telegram rooms had migrated into some, small groups. Actually, a small group that started out with like 12 people is now like 160 smart minds in there. But a regular conversation that always comes up, and we talk about it sometimes for hours, is how do you decentralize banks, and how do you bank on yourself with your own assets? You always hear that wealthy people, extremely wealthy people, you hear this term, well, how come they never pay taxes? They don't pay taxes. Well, it's because they don't sell their assets, right? And anybody can do that. We should all be on the same level playing field. If you don't want to sell something and you'd rather take a loan, well, guess what? Loans typically are not taxed, right? If you had chosen to sell your Pulse coin to extract value, you could lose 40% in capital gains, maybe,
or
1
more
to 5% in slippage on Uniswap or Pulse Swap. So, potentially, I don't know, 40 to 50% loss just because you chose to sell something to extract value. And then at the end of that, you no longer hold that thing that you didn't really want to sell to begin with. So instead, just lock it up, extract value in the form of a loan, and there's typically no taxes on a loan.
Very, very cool.
Could be implications if you under collateralized, there could be tax implications for you. Choose to collateralize at a safe level, and you may never have to pay, those taxes that everyone dreads.
Yeah, no, well, I mean, not to mention there's so many hidden taxes in at retail, right? At the point of sale anyway, right? It's not like it's a completely wrong-headed to believe that we don't pay taxes when you skip the capital gains side of being taxed to that level, like you're saying, 40, 50%. I don't want to get too political there, but I'm pretty staunchly against paying taxes in whatever legal way you can manage to do it. So, because I don't like the way a lot of the taxes are being spent, frankly, by the government. But that's a personal bone that I had to pick with the U.S. government.
Everybody's going to pay their tax. Everyone's going to eventually pay your taxes, people.
Yeah.
And talk to your tax advisor. And if you sell your Pulse coin, I can just about guarantee you're going to have some sort of taxable event, some capital gains, or maybe even loss. Hopefully not, but capital gains from selling your Pulse. But obtaining a loan introduces a whole new set of rules that could be extremely tax advantaged.
Awesome. Well, let's talk about that just a little bit, and let's explore some of the. I mentioned this before the call. Let's explore some of the potential strengths, weaknesses, opportunities, and threats. Right, your classical SWOT analysis, because you guys are beginning this enterprise in a decentralized fashion. So that sounds like a strength, right? You don't have any kind of a corporate formation that could be some kind of an attack surface for would-be regulators or for would-be competitors or enemies of whatever your goals are, your vision is. What do you see as a potential weakness in having that decentralized approach? Is it possible that there could be any kind of an introduction of, say, I don't know, bad smart contract code or bad pull requests for any of the repositories you guys are going to work on? What have you, based on what you guys have looked at so far, do you see any weaknesses that have yet to go unaddressed or that maybe are still roadmap items?
Well, luckily, we didn't form this all from scratch. Okay, it's an existing protocol on the Ethereum chain that's very, very well thought out, been audited numerous times. We forked that. We're also going through multiple audits as well, because there are some RPC setting changes and a couple other things, Oracle calls and stuff, so that have to be changed. So we're also going through audits on the code that was produced after the fork. What are the threats, though? I'd like to remind people this is completely decentralized. It's immutable. We can't change the code if we wanted to. Sure, we can update the front end. The back end code is open source. Anybody is welcome to build their own front end on top of that if they want, and I'm sure people will. But it's a successful project already that's already been through the ringer, and it's been through some major market dips. Back in May, when Ethereum really took a pretty deep dive, it was really interesting to watch a lot of stable coins trade for as low as like 70 to 75 cents for a period of time. And you're like, wow, isn't that supposed to be $1? Well, you looked at this protocol that we forked, and it traded at 95 cents for a short period of time. You're like, wow, it only lost 5% of its value for a brief period of time. Those people just had to, hold for half a day, and it bounced back up again. Well, that performed pretty well. So, what are some things people could try? Well, a question that's always asked is, well, can whales take advantage and try and dump the price to liquidate Pulse and then obtain Pulse because they have a big share of the stability pool? Well, a couple things. There's not going to be one single whale that owns the entire stability pool. So remember, any liquidated Pulse goes to all of the users proportionally. So he would only get a fraction. And even a huge whale might only have a percentage or two, of that pool. So he's liquidating, a couple accounts if he dumps really, really hard, so he can get a fraction of those accounts. So he's really hurting himself more than he's gaining. Not to mention he had purchased Pulse just to sell it, to dump the price on himself to obtain a tiny fraction of it. No, it's much easier and much wiser for him to just go buy Pulse on Pulse Swap.
Okay, so it sounds like
take a loan, and he's got the money in his hand, ready to do whatever he wants with by getting a loan. It's much wiser to do that.
Okay, so it sounds like then that potential threat vector, if it were legitimate or whatever, that same actor, they've got greater incentive while you're still ramping up adoption and that pool is low for them to get a higher percentage of whatever that liquidation event is. It sounds like the game theory mechanics, it's better for them to just camp out on, like you said, Pulse Swap or whatever Uniswap fork there is, to just sop up available Pulse from weak hands as they exit from the initial public listing dump or whatever, if that happens.
Absolutely.
Okay, cool. So it sounds like then, I don't know if you guys have modeled that out. I don't even know what the table would look like as you try to figure out, okay, this is the point of no return. We finally have enough participants that there's no possible way this could even, happen in any meaningful way. Just because someone, whatever, sour grapes, they're not even doing it for the money. They're just trying to be a jerk, throw a wrench into the works for you guys. Have you guys already modeled that out? I mean, I don't know that you really have to. It sounds like in terms of like making a gainful exploit, it's not gainful. But a spiteful exploit, that does happen too. Like, what would it take for you guys to get past that initial point of no return?
Yeah, so we've drawn it out as a team. We've spent days and days trying to think, well, how can we break this thing? Let's run through the scenario. We're drawing it out on napkins. Well, what if I did this? What if I did that? What if I had $2 billion when I came into the protocol? What if I just ran loops on loans? Let me explain that. People always ask.
Yeah, well, yeah, I've been in some degen groups that talk about that, and they've been the beneficiaries of some of these decentralized lending markets that have just been like destroyed by loops. But please, how have you guys thought of it?
So here's what's interesting. Degen behavior usually leads to whoever's attempting it losing. Okay, so let's say you come into the protocol. You obtain a loan, so you lock up Pulse, you get stablecoin. You say, oh man, now I can go buy some more Pulse coin. Okay. You go buy some more Pulse coin, and then you say, well, wait a minute, I can just lock this up and I can get some more loan too. So you just keep running in circles. But what you're not thinking is every time you do that, you're locking up more Pulse. It's locked up. You're unable to withdraw that because it's locked up pending you paying it back. And you can't pay it back because you've already taken that stable coin and you've spent it to go buy more, right? So the only thing you're doing is pumping the price for the rest of the community. And then at the end of all this activity, you scratch your head and you say, well, I can't get any of that Pulse out anymore, right? And I only have a little bit of stablecoin in my hand. So I hope I pump the price of Pulse enough where it keeps pumping, where I can eventually withdraw some of that Pulse. But you really just made it really hard for yourself, because you just locked up more Pulse just to raise your debt, and then you locked up more Pulse, and then your debt went up, and you just kept doing that over and over. So that's a really degen behavior. I wouldn't suggest it to anybody.
Got it.
But it would help. It would help the price of Pulse if it was just constant buying pressure as you're helping the community.
Well, it sounds like it would help the market cap or whatever, which is one of those measures that people care about when it comes to stablecoins. It sounds like it would help the market cap of USDL too, and then maybe the pool of loan the loan token that's being utilized and being sort of watched by the community, because that more the heavier participation, right? Kind of a virtuous cycle upward. Not so much degen, like trying to grind anything down the other way. But where my mind goes when the game theory mechanics of lending abuse comes in, decentralized lending abuse comes in, is not so much in one protocol, but in a couple of protocols that are being arbitraged, right? So where you've got maybe something along the lines of USDL being thrown into a liquidity pair with something else, right, on a separate AMM. And then the possibility of there being a few exploits that way that aren't necessarily, they're not necessarily spiteful or malicious. It's just that there are some other protocols where, for larger holders of Pulse, if they can get their hands on a stable side of a liquidity pair for a different AMM or DEX, that they may really make out really well for a while. I mean, DeFi Summer 1.0, man, people were getting ridiculous APYs on some of these yield farming plays, including, if I remember correctly, there was this kind of obscure, was it called Hex Shrimp Farm or something, including like some people doing some really big APYs off of Liquid Hex at the time. And I was only tangentially aware of that, but now when you throw a stablecoin into the mix, I think that there may be some known unknowns in that space, because we've seen examples of it. They just haven't been announced on Pulse yet, right? So that's kind of what I'm wondering about mostly, is there the possibility of that coming in and then somehow there being an unintended negative consequence, right? Like negative externalities that then affect not only Pulse, but liquid loans.
The stablecoin, the USDL, inside our protocol is always redeemable for $1 worth of Pulse. You can come into the protocol and you can exchange it for $1 worth of Pulse. Okay. So if some interesting things happened on some DEXs, some automated market makers, and the price did something really weird, it would very, very quickly be arbitraged inside of the protocol, and it would restabilize itself. We can't say what people will do with Pulse, other than we will be incentivizing liquidity providing with the stablecoin, on Pulse Swap, possibly Uniswap.
Got it. Okay. Now, on that note, so there are multi-chain platforms like, say, 1inch DEX and Matcha, and then a few others as well that have not locked themselves into whatever, strictly Ethereum or strictly Binance Smart Chain or strictly, say, Polygon. There are a few notable DEXs that are forks of Uniswap that are single chain only, and then there are a few that are multi-chain, like 1inch DEX. What is the likelihood of there being a protocol like the one that Liquid Loans is based off of, just deciding for whatever reason, we want to go multi-chain as well? Is that a possible risk or threat in the future? What have you guys found so far?
Well, we want Pulsechain to be very successful with a lot of different protocols running on it. We welcome any protocol that's decentralized and trustless. Go ahead and come over. Let people use it, as long as it's decentralized and trustless. No counterparty. Yeah, that's cool. We fully support that. And we welcome any of that competition as well. If people, you want to try and launch a stablecoin lending platform, have at it. It gives us it just ups our game. Okay,
cool. Yeah, I mean, certainly I think that's been the case for a lot of us who tried out 1inch versus some of the other like DEXs. Having aggregators has been I think a net positive thing in the DeFi space. But I wasn't sure if there had been any indication from any any similar programs or protocols that have just said like, you know what, maybe we will go multi-chain and maybe this maybe Pulse makes sense for us, but nothing yet?
I have heard of some protocols that are coming over. I can't mention those names right now. There will be DEXs, there will be bridges, some built by the community. There will be NFT platforms. There will be some meme coins. There'll be some treasury type protocols. I think we're going to see a lot of activity in the first 6 months of Pulsechain, of brand new projects that nobody's ever seen before. And then following that, you'll see all the existing protocols from the other chains say, oh, wait a minute, did we just miss that one? And then they'll be migrating over.
Okay, so it sounds like then right now Liquid Loans, one of the sort of technological moats, or I guess competitive moats that you're hoping to build in this first quarter or two or year of Pulsechain going live, is that you're first to market and you're deeply entrenched in the Pulse and Hex community. It sounds like, I mean, are you getting pushback? Are you getting anybody saying like, you know, I'm a conscientious objector and this is wrong and this is not what Richard would have wanted. It's not what Satoshi would, you know, all the stuff people say. The tribal stuff.
It's actually pretty fun, right? Because every now and then we get somebody who's immediately opposed to the idea of loans, right? They think, oh, that's leverage trading. I'm gonna lose all my money.
Yeah.
And it's only after, hey, wait a minute, think about reading the white paper. Okay, you'll get about 5 pages in, and your mind's gonna be changed, right? And almost every single time, you'll have, you know, an occasional hater. They'll come around and they're like, wow, I've heard people that have said, man, I was super opposed to this from the beginning, but now this is absolutely necessary. We have to have this not only on this chain, but DeFi needs this across all of DeFi. So I do highly suggest people read the white paper. Look at some of the other videos. Our website's about to go through its first major update with a whole bunch of materials for people to read.
Okay, and for the audience, for the benefit of the audience, we always do our link lists in the bottom of these videos so that everybody can do due diligence immediately from here. Like, I'm not a big fan of like, oh, we're going to hold it over your head by just, you know, by cherry picking what we talk about on stream or on the video. Right. No, all the links are available in the description, guys. If you're watching this video, just click the link. You'll be able to read everything that Jesse's talking about right now.
Right.
But so that's great. I'm glad that you have the white paper is robust enough to help people really understand what's going on there. And the website now is apparently getting its first major update. What I'm curious about as well is specifically, and I know this is kind of more of a Pulse ecosystem question than it is really a Liquid Loans question. But as of early on in the Liquid Loans lifecycle in USDL, is there a plan? Oh, you got a little guy.
All right, let's back that up. Like,
yeah, no, and I'll cut your child's image and likeness out of the video. I don't let my kids on camera at all for this stuff because it's a weird world. Let me grab my pen real fast. Yeah, kids all want to be on YouTube and TikTok until they realize that YouTube and TikTok professionals get stalked and doxxed and swatted and stuff. It's so bad, right? But So the question that I have is, I know this is more of a Pulse ecosystem question maybe than a Liquid Loans question per se, but is there a plan for support of USDL on any of the early forks of Tornado Cash for Pulsechain? The same way that Tornado Cash supports Tether and USDC and DAI right now on Ethereum.
That's an interesting question that nobody has ever asked me.
It seems essential, doesn't it? I'm just saying, like, these are things that the fees are high, but these are some perks of staying on Ethereum right now. I want to see this on Pulse.
I can't say that there would be any sort of incentive for using Tornado Cash. However, depending on how it works on the Pulse chain, if it only accepts Pulse coin or if it accepts any variety of PRC20s, right? USDL, even the loan token itself, is a PRC20. So we'll just have to see how the protocol evolves under the Pulse chain and go from there.
Okay, got it. Yeah, so I apologize. I'm asking this question out of ignorance. I don't know who may be working on the first native fork of Tornado Cash for Pulse Chain. I don't know if the Tornado Cash team, for example, is going to add chain support the way that they did for, say, Polygon, and the way that they did for Binance Smart Chain. It's funny because they were late with Binance Smart Chain, so there's actually a higher throughput fork of Tornado Cash for Binance Smart Chain that is not them. So, so I imagine, just based on some of the other like public announcements of protocol support for Pulse Chain, that there's going to be an opportunity and first mover advantage there as well for just a dedicated fork. I don't mean to like steal the thunder of Liquid Loans. I just see it as being part of a necessary, healthy, vibrant ecosystem where USDL is that first class citizen, right? As like the preferred stablecoin. I would see mixing as being essential.
Right. Well, it's likely to be the only stablecoin initially.
Okay.
Let me explain. So every stablecoin on Ethereum right now is backed in some form or fashion by some collateral, right? Like I explained at the beginning. And in the case of Circle's USDC or Tether's USDT, that's fiat. Okay. While those tokens will migrate over, they will be cloned over to the Pulse chain. They will no longer hold a peg. They will no longer be redeemable for fiat from the Pulse chain version of it. Okay. ERC20s with that token contract are redeemable. PRC20s are not. Okay. In the user agreement of Circle, it literally says that in the event of a fork, they're simply going to turn off the contract. They're not going to allow redemptions. If they choose to come over, they can issue a new contract, which would then require people buy it, right? So you can't expect to just fork off USDC, clone it onto a new chain, and then Circle is just going to cut their business in half and just give away all this free money. Otherwise, people would be just forking off chains left and right until Circle didn't exist anymore, until they went broke. Okay, you can't. So the tokens will exist. They will become tradable just like any meme coin would. They won't hold a peg anymore. So that's certain stablecoins. Now others that rely on a protocol, such as like our protocol, like Liquid Loans, it requires the protocol and some arbitrage inside of the protocol, some collateral to be backed, and there has to be a front end and such. Well, think about the different lending platforms that are on Ethereum right now. And while those tokens will be copied over to the Pulse chain, that doesn't mean that their front ends and all their code that's migrating over. First off, the front ends aren't migrating over unless the devs do some work. But even the back end codes and all those contracts won't be functioning correctly anymore. They'll be looking for Oracle price feeds from Ethereum, but it's residing on the Pulse chain. So it's not going to be reading anything correctly. Those tokens will also likely go to zero. So I don't think that we're going to see any working.
Hey, Jesse, can you still hear me? I think we got a pretty gnarly network interruption there. Sorry about that. This is one of the joys of using an open source and encrypted service like Jitsi. It's not quite as reliable as Zoom, but when it's encrypted, you know there are no third parties listening in. Sorry about that.
So I'll just back up a little bit. So the fact of the matter is, most of any, if not all of the existing stablecoin and lending platforms that are migrating over to Pulse chain, at least the tokens, while the tokens will reside there, that doesn't mean that they will work anymore. That doesn't mean that they will hold peg and they'll be redeemable, so on and so forth. So it is likely will be the only working stablecoin that holds a value.
Okay, got it. That makes sense too. I mean, an algorithmic stablecoin is something that I feel a lot better about, especially if there are no admin keys that are going to do remote burns, right, in people's wallets or remote freezing and such. That's always kind of hasn't really set well with me. The fact that Tether and Circle, that sometimes, who knows what the criteria is for just deciding we want to freeze the funds in such and such account. That's always felt a little strange to me. They can just remotely like zap my holdings. So knowing that, like, right. I know how I got my cryptocurrencies, and I know that I did so legally, and I have the chain analysis and the full transaction history to prove that if due process were followed and I were asked to. But like, what a pain in the neck it would be to wake up one day and realize, okay, I had, whatever, a small amount. I had like 15 grand worth of Tether in an account, and it just stopped working. I mean, if that happened to your bank account, you'd be livid. It happens right, to people's PayPal accounts all the time, unfortunately. That exact example right there. But yeah, but I mean, that's a different story. In your bank account though, for your business, you'd be livid. That's like the amount that you might need for daily operations for your business. So to know that that's possible in crypto is, it's very unnerving. So it sounds like Liquid Loans solves that problem by being decentralized and having the core smart contract itself not be gameable. You have to present with collateral that you control with private keys.
Right, exactly. And unfortunately, the stablecoin dilemma that we described is not unique to DeFi. So any of these protocols that have staking or have some sort of yield farming or some sort of functions inside of them where they're using subgraphs or oracle calls, a lot of that code is going to be broken on the Pulsechain. Okay, it requires some action from the developers of those protocols to change the code on the Pulsechain so that those function correctly. But that means they have admin keys, which, oh, by the way, 70% of DeFi has admin keys, right? So it's like a double-edged sword, right? We want all this stuff to work, but they have to change the code. And maybe they have a governance token and it requires a vote. But maybe that's not a big deal because all the founders have all the governance tokens, right? So it's just going to be a weird thing, right? We're just going to have to see what works and what doesn't on the Pulsechain.
Yeah, no, that's great. So on that note, I guess I had another question. It's kind of like it's slipped my mind at this point. But I tell you what, this has been so great. If I have follow-up questions, can I hit you up for another interview like this and maybe gather some community questions? We come back with something that, because I've got to tell you, man, you see that I got the little GPUs connected to the heart, and I built my channel on proof of work mining, which I know is not everyone's cup of tea. But I've got a lot of love for the GPU mining community because they wind up getting their hands dirty with crypto and dealing with, protocols that are unfinished and really exhibiting a lot of faith with long-term hodling of moonbags and stuff. They wind up having really great questions. So you'd be okay if I invited you back on to see what questions my community has and bring them back to you?
Yeah, of course. Anytime.
Awesome. Well, this has been really great, been really illuminating to the audience. You guys see all the links down in the description. But let me ask you, Jesse the Pit Boss, what's the best way for people to immediately get a hold of either you or members of the Liquid Loans team to have questions answered and to maybe offer help if they're able to? And I guess a follow-up would also be, what kind of...
The best place would be our Telegram page. There's a lot of users in there.
Oh, I apologize. We're a little off. We're a little out of sync.
24 hours.
Sorry about that. I guess the follow-up question would be, what type of community help are you guys looking for right now if people did want to offer help?
Yeah, so inside of our Telegram page, we have 24 hours, people asking questions, having their questions answered, interacting with each other, going in voice chat. We have some pinned messages at the top that have some important information, our white paper, some other videos that I've done, some the live feed to get any live information, the latest, greatest, and that's our Telegram. What do we need from the community? We just need people to know that, hey, don't worry, there is a stable coin coming. It's called USDL. And oh, by the way, you don't have to sell your Pulse coin. That's it. That's all anybody needs. Nobody wants to sell their Pulse coin, because when they do, they're going to live with regret as the price continues to go up for eternity and they've already let it go.
Awesome. Well, hey, I love the sound of that. I don't know. I mean, I don't know what reasonable person doesn't like the idea of being able to hold on to their assets and be able to derive these kinds of synthetic or algorithmic stable pegs from them to be able to make that coin immediately useful and perhaps, again, talk to your CPA, decrease their tax liability. That for me is like chef's kiss, just amazing. Yeah, legally decrease your tax liability. Don't avoid your taxes, but legally, yeah, if you can, decrease your taxes. It all sounds great. So thank you so much for your time. Audience, if you haven't already gone over to the Telegram group, again, links in the description. So go say hello to this guy, Jesse the Pit Boss. And thanks for watching to the end, guys. Jesse, thanks so much for your time.
Yep, thank you.
I felt like I learned a lot more about how this protocol is going to work. I had some questions that only Jesse and some of the team at Liquid Loans could answer. So rather than waste their time in Telegram asking privately, I decided, you know what? I'm just going to go ahead and ask for an interview and try to get some answers to those questions publicly so that I can talk about it in the open with my audience that may want to know about this gem. I haven't been promised any kind of compensation, and this is not a sponsored video. I was just that curious about it because having a stable peg to the US dollar or some kind of stable coin on a new project launching like Pulsechain is pretty important. And we've needed better decentralized options than DAI for a long time, right? USDC, Tether, DAI, they're kind of the biggest games in town, but they're not the only game in town. And I'd rather see more decentralization. So this was, for me, it was a breath of fresh air being able to talk to Jesse, and I'd love to follow up with him in the future. You let me know in the comments section, though. What questions do you have for Jesse the Pit Boss or for the Liquid Loans team for when I bring them back on? Would you prefer we do a live stream? But if we don't do a live stream, what are the questions you want me to ask them? Let's line those up in the comment section down below, guys. Thank you again for being subscribed to the channel. Thank you so much again for clicking the bell icon so you know when this media comes out. It is essential that you get this info and that you get it in time, right? You don't want to be late in this market. Thanks again for hitting that thumbs up button, sharing this video. You're the reason I make this media. You know, I love your face. Remember to stay private and mind your biz. Thanks for watching to the end of the video. Be sure to check out mineyour.biz, where you can sign up for our email newsletter, where we're still ramping up content, but you will occasionally receive specials for flash sales and all kinds of other deals that we have going on the site. You can also check out our services page, where we offer consulting to projects that need it. You can pick up the Freedom Phone, which respects your privacy. You can pay for it in crypto and have it shipped to you anonymously, as well as getting merchandise that also is paid for with crypto. That's right, we practice what we preach, including, well, a Flux swag page. That's right. It's a dedicated page just for the team over at Flux Network, because we love them that much. Thanks for watching to the end. Thanks for being subscribed. You know I love your face. Be sure to stay private and mind your biz.